So today I want to talk about interest rate parity, how that relates to exchange rates, how that might tell us where exchange rates are going. Now, I've previously discussed purchasing power parity, which gives us some sense of where exchange rates should be. You can check out that video if you follow this link here. All right, so as I mentioned in the previous video, there are exchange rates around the world. Here's an example of some recent exchange rates for the US dollar and other currencies. As I mentioned in the previous video, these things change daily. So here's a kind of a sense of, a change you might see in a 24-hour period of time. The question is, why are they changing? Can we predict how these might change? All right. So one way we might be able to do that is by looking at interest rate differentials between the two countries. So in fact, there's kind of a theoretical formula for how this should work. So if you think about what the future exchange rate is going to be, it's related to the current exchange rate and the interest rate differential between the two countries. Now, how does this work? Why does this work? Well, if we think about it, it's kind of an arbitrage opportunity here in some ways. You have a certain amount of money to invest, say $1 million. You could invest that and earn an interest rate in the United States, and it will grow over a certain period of time to a certain amount of money. You could also take that money, convert it to another currency, and invest it at that currency's interest rates, and then see how it grows, and then flip it back to US dollars. Those things should be equal, and they kind of imply what that exchange rate should be at that future point in time in order to make that number add up. Now, importantly here, you'll notice that the country with the higher interest rate, it depreciates relative to the country with the lower interest rate. So keep that in mind here. Now, what I want to do is just take a quick example here and see if that actually if that makes sense or if that actually happens in practice. So we take the current US exchange rate, the current forward rate, and the current interest rates. We can put that in a formula here and do the math. You're welcome to pause this if you need to. And it turns out that if we do the math, they're not quite equal here. So we see a forward rate of 1.2226, and we see kind of what it should be at 1.215586. All right. But what I also want to do is I want to think, well, this is one example here, but I want to go and see what the rest of the market is saying, because this is a 1-year forward rate. What if we look at the full market and see what's happening here? So again, what I'm going to do is I'm going to look at 1 month forward rates, 3 months, 6 months, 9 months. I'm going to look at all these different forward rates and see what the implied interest rate differential is between the two countries to see if we see a pattern here. Now, as we go from 1 to 3 to 6 to 9, we should expect that number to grow because the differential is being compounded over a longer period of time. But interestingly, if we look at that 1-year rate, kind of the implied differential is 0.83 or 83 basis points when the actual differential is 25 basis points. So it seems like there's a bit of a disconnect here in the market. Also, should point out that the 2-year, 3-year, 4-year, all these numbers, that is for the full time period. They haven't been annualized. So let's go ahead and annualize that to take a look at that. We do that here now, and we can see that these make a little more sense, but they are continuing to grow to the point where at 10 years, we're expecting that interest rate differential over that full time period to be equivalent to 154 basis points, right? So this doesn't make a ton of sense from this framework, but that's the information that we see out there right now. I should also point out that when we talk about interest rate parity, people will talk about covered versus uncovered. We're not talking about pots for boiling water. No, yes, we are talking about interest rate parity. So the idea here is when it's covered, those things add up, right? So the interest rate differential and the forward rate make that equation equal, right? And what we just saw is right now interest rates are uncovered. Now, of course, the key point here is that those interest rates, that's the Fed funds rate, which the average investor isn't going to get. People could have different invest interest rates in different markets, et cetera, et cetera. So it's a little bit naive, but what we're seeing, at least on the surface, is that right now we have a lot of uncovered interest rates. So of course, one criticism is the opposite happens. So we said that the currency with the higher interest rate depreciates, but what we actually see in practice is the opposite happens a lot because people are attracted to the currency that has the higher interest rates. They're chasing that. Again, as I mentioned before, do you have access to those particular interest rates? the market participants have access to different markets. And so it's not as cut and dry as we're seeing here. Also, there may not be, instruments like forward contracts available. So you can't take place, or you can't try to arbitrage this away. Next time we'll talk about another interest and another exchange rate mechanism, which is balance of payments. I hope you enjoyed that. I'm Brian Kozlowski.